All right, let's get started. Welcome to Crypto Corner, everyone. Your crypto radar for all the latest news, reviews, market analysis, and tutorials that help you master the crypto markets. My name is OJ, and in today's video, I will be showing you some of my best trading strategies using moving averages. Of course, it is important to combine several different indicators, not just one indicator, in order to get a better idea of the most probable market moves. But moving averages are quite accurate and I use them a lot. Trading is a numbers game, but in fact, the charts are simply illustrating the market sentiment. Buyers and sellers are in a constant battle and the price moves according to the demand and supply. But both of these factors are changing. At some point, the demand is growing way above the supply, resulting in higher market value. But the demand is motivated by personal sentiment, so as soon as investors get scared or even just being uncertain, this is enough to diminish the demand for an asset or a stock or a currency. And just like that, the price will tank lower and lower. And it really helps to be able to see that this is coming, to take action, to be prepared. So today I'm going to show you my most successful trading strategies using moving averages. These are indicators that we commonly use in technical analysis and often in addition to other indicators, but even on their own, they're very useful. The reason for calculating the moving average is to help smooth out the price data over a specified period of time by creating a constantly updated average price. A simple moving average is a calculation that takes the arithmetic mean of a given set of prices over a specific number of days in the past. For example, over the previous 50 days or 100 days or 200 days. Now, exponential moving averages, which is what we're going to use, this is a weighted average that gives greater importance to the price in more recent days, making it an indicator that is more responsive to the new information. It is also referred to as the exponentially weighted moving average. It reacts more significantly to the recent price changes than the simple moving average, and this is why I prefer using EMAs. So I will show you how to use two pairs of EMAs, the 5th and the 8th EMA as in pair, and then the 9th and the 50th EMA. These I use all the time to find good entry or exit positions. I will be using this for spot trading, meaning that simply buying and selling positions. I'm not going to be using leverage or futures trading where I'm betting on a price and I'm opening longs and shorts. I will be just buying and selling because this is what the majority of people are doing and it is the safer trading anyway. So let's get started. Alright, so first we're going to start with the 50-day exponential moving average and the 9-day exponential moving average. The long one, the 50-day moving average, is orange and the 9 is purple. I've opened them, both of them here. I've opened it as an EMA cross, but you can also open them separately. The short one I'm setting up at 9. This is on the daily, that means 9-day exponential moving average. The long one I'm setting up at 50, so the 50-day moving average exponential. Right, so what I'm looking for, the rule of thumb is, if we break above the 50-day moving average, I'm entering a trade. If we are breaking below the 9-day moving average, and of course I'm gonna combine this with looking at how we are doing with the 50-day, but typically the 9-day moving average I'm using to show me when to exit a trade, but the 50-day I'm looking for when I'm entering a trade. So as you can see here in the middle, this is price action below the 50-day moving average, so typically I would not be taking a trade during this price action. As we break above this 50-day moving average, this is when I'm going to enter the trade. And I might not enter it straight away. I might actually wait for a confirmation because as you can see here, we are breaking above this, but the very next day we are dropping below again. So this is not a confirmation. So I might be waiting to see as we break how we're going to react the next day. And only then when I see that the following day we are continuing to be above this moving average, I'm gonna take the trade. Now you might say, well, here we actually broke above it and we stayed above it, but we still managed to drop. Well, yeah, that happens as well. Not every trade you take is going to be successful. Not every time you're going to be in profit. Every now and then you have to take a loss. Every trader makes losses. The whole point is that if you're taking this loss, maybe it's not even a loss. Maybe you bought as we broke up and then you sold pretty much at the same price, so it's not really a loss. But even if you're selling below your buy price and you're taking a small loss, the whole point of this is to save you from further losses. So if you exited the trade here and then we went even lower, you actually saved yourself from a further 3% drop, or 4% drop, or whatever happened later. So the whole point is that even if you're taking a small loss, you have to protect yourself from bigger losses. Now, on the way up, it's actually easy. On the way down, it's a little more tricky. So as we break above the 50-day moving average, I'm gonna enter a trade. And as I get the confirmation, I'm gonna enter a trade, especially if we have that bullish cross here where the 9, the shorter one, is moving up, crossing the longer one on the upside. This is always a bullish signal. So definitely I'm entering the trade here. And as I'm entering, I'm riding all this wave upwards. Now, as you can see here, the 9 moving average is acting as our support. On the way up, every time we come down to test that support, we bounce up from it. Every now and then, however, we will break below that moving average. And as we break below it, I might exit a trade, but also I'm going to be looking at the 50-day moving average and how close we are to that, because it's these two when they are about to cross on the downside, the short one crossing the longer one on the downside. This is where we're getting really bearish. So this is what I'm looking for. So even though we come to test this and we break it briefly for a couple of days, I might not exit my trade just yet. If I see though that these two moving averages are getting really close together and we are breaking below the 9th, then I might exit the trade because I would be expecting a bearish cross. So at this point, I'm staying in the trade, or even if I exit the trade, I'm re-entering as we break again above it. So we continue going up and going up. Let me actually zoom out of this. And as you can see here, this is when the two moving averages are getting really close together. And as we drop below the 9th moving average, most likely I would make an exit. But as you can see, the next day we are breaking above it again and we are avoiding these two lines getting too tight to cross. So I get confidence again and I'm re-entering, and I will keep riding this bull run all the way up. Now at some point, yet again, we are breaking below the 9th moving average, but it is a false alarm because as you can see, after a few days we break above it and we continue all the way throughout this bull rally. We are above the 50-day moving average. This is really important. So as long as we are far from the 50-day moving average, or even when we come to test it, we don't really drop or break it, we are still bullish. So I'm staying in this trade. Even if I exit in the short term, I would re-enter. Every time I exit and I see that we are not breaking the 50-day moving average, I would re-enter. I'm really worried if we break the 50-day moving average. And this is what happens here. So as you can see here, we go up and up and up. At some point we break the 9th moving average. Literally the next day we are breaking also the 50-day moving average. We come to retest it and we break. At this point I'm gonna be exiting, and I could be a bit hasty and exit a bit too soon, but as you can see, we drop lower, we manage to reclaim this, we climb above it for a little bit, but then we drop again. So the question is, am I going to stay in this trade? Am I going to be out of this trade? What am I going to do? It really depends on your discipline. If you are patient, you might actually want to wait and get a better confirmation that we are continuing the bull run. Otherwise, you might be entering at this point here as we break above these moving averages, as we break above both of these moving averages, but soon after we break below the 9th and we break below the 50th. So definitely, even if I've entered again, definitely at this point I will be exiting. And look what happens after that. All of this drop you can avoid if you exited up here as we broke the 9th and the 50th moving average. The two moving averages make a bearish cross, as you can see here. So the shorter one is crossing the longer one on the downside. This is the bearish cross. And this is definitely confirmation that we are expecting more bearish price action. This is why I'm exiting this trade at this point, and I'm not interested now in this until we break above the 50-day moving average. So all this price action I am missing out on. I'm skipping this. I'm waiting patiently. At some point we are breaking above the 9th moving average, but this is not for me the signal to enter the trade, because we could break the 9th moving average and still be far from the 50th and not having a bullish price action. So at this point I'm waiting to break the 50-day moving average. And you can say, well, if you buy down here, you will have more of a profit than if you wait to break. But I'm waiting for that confirmation, because buying down here is still a very risky trade. Because as you can see, we are still making lower lows and lower highs. So I'm not interested in entering a trade as we are making lower lows. This here is a lower low than the previous one. This here is a lower high than the previous ones. So as we're making lower lows and lower highs, I'm not interested in taking a trade. As we break for the first time this 9th moving average, I'm waiting for more confirmation. So this is why I'm using both of these moving averages. Now as we break above the 50 moving average, this is when I'm entering a trade, and now I'm going to be riding all this bull rally upwards. And again, the 9th moving average is acting as a support. We are breaking it briefly. Every time we break it, we manage to climb back above it. So I'm not worried. I'm not exiting a trade. However, here, this is when I'm getting worried and I'm exiting a trade. It is very brief. This is most likely a somewhat of a black swan event or some other kind of a bearish news in the media or something else that drove this market down, and it was very brief. So as we climb back above the 9th and the 50th moving average, I'm entering the trade again. And yes, you can say that I'm not really making any profit from this trade. I might even be making a loss because I might have sold down here and bought up here. But this here is a very small percentage, a very small difference. So if I exited somewhere around here and I entered again around here, this is a 4% difference. So at the worst, I've lost 4%. So it's not a big deal. I mean, compared to the profits that I will be making by entering this trade after confirmation and staying in this trade all this way up, I mean, this here is a much bigger profit. Let's say I entered here and we went all the way here. This is 50% profit. So I don't really care about a small loss of 4%, but at least I protected myself, because if this didn't play out the way it did, if this was actually a start of a bigger correction, we could have dropped lower, because as you can see, lower highs and lower lows. So at this point we are at danger. I don't want to stay in this trade. I'm protecting myself by selling here at this bearish cross, and at the bullish cross I'm entering again. I'm making 50% from this trade, so I'm not really worried. Maybe it's not even 50, maybe it's less, maybe it's 40%, because as you can see down here, we make another bearish cross and I'll be exiting this trade. Most likely I will be exiting the trade around here though, because as we break below the 9th moving average, and as we are now very close to the 50th, we come to retest it, and we stay below the 9th moving average the next day, most likely I will be exiting already at this point. I'm not gonna wait for the actual cross. At this point I'm expecting this cross to happen. I see that the 9th moving average is getting really close to the 50th, and of course I'm expecting that very soon it will cross it, and that will be a bearish cross. So most likely at this point here, after a couple of days of staying below the 9th moving average, I will exit this trade. And then what happens? Well, this happens. We drop by, what is this? Oh, that's at least 40% drop, if not even more. So let's say, well, the actual drop is 52%, but let's say that I exited here after I got the confirmation that we are staying underwater. Well, I saved myself from a 45% drop, right? This you can say, because this is longer term, you can say, well, if we are underwater for a long time, like for instance this whole move here, we are staying underwater, so I'm staying out of this trade. And you might be thinking, I don't really want to be staying out of a trade for that many days. This here is months. I mean, this is in November, and this is February. So we're talking here almost 4 months of price action that I'm staying out of these trades. So you might say, I don't really want to stay 4 months out of a trade. Well, let's look at the other moving averages now that are shorter term. This is the 5th and the 8th EMA. Again, exponential moving averages. Hold on, let me make them slightly thicker so that we can see them better. Okay, so these are shorter term moving averages. One is 5-day moving average, the other one is 8-day moving average. The shorter one is the blue, the longer one is the pink. And yet again, we are looking for crosses. A bearish cross is what we just saw here, and this is telling me that I need to get out. So if I want to be trading shorter term, I would be using these moving averages so that I can still take advantage of these short-term price swings that are happening, even though we are below the 50-day moving average. And technically, I wouldn't be taking a trade below the 50-day moving average. But if I'm tempted to do that, well, here I have a bullish cross where the blue one is crossing the pink one on the upside. The shorter one is crossing the longer one on the upside. So this here is a bullish cross that is telling me, okay, I can take a trade. So I can enter here and I can ride this bull run here all the way until I see a bearish cross. Or I don't have to wait for the bearish cross. I can actually anticipate that it's happening already as we get these two lines really close together. So at this point somewhere here, I can actually get out of this trade. I can sell. And of course they make a bearish cross. So now we are going downwards. Okay, so let's take some more examples. Now here we have a bullish cross. So you enter a trade and you stay in that trade all the way up until here. Now at this point they're getting really tight together, so you might be tempted to exit the trade a little early. But as you can see, they didn't cross. And that was very accurate because we continue to go upwards. So we are staying in this trade and we are staying in this trade all the way until here. With this big red candle, we actually drop so much that it pulls the 5th EMA below the 8th EMA. And this is the bearish cross that I'm looking for. At this point, I'm exiting the trade. And as I exit that trade, we are actually going further down and further down. And at this point, we are making another bullish cross, which is my signal to enter a trade. So in the short term, and of course, this is not super short term because we're on the daily. So we're talking here about a couple of weeks. But this working on all time frames. So you can use them on the 1 hour time frame, 4 hour time frame, even the shorter one. I don't really trade intraday. I don't do 15 or 5-minute time frames, but you can use these EMAs even on the shorter term. You can also use the 9 and the 50 on the shorter term, but for me, the 50 and the 9 are working the best for the daily. The 5 and the 8 EMA, they're working great on the 1 hour, 4 hour and the daily as well. So I'm using them for the shorter term trades as well. And here is another example. We have a bearish cross of the two moving averages. So we exit the trade and now they're going down and down and down, and we are just out of this trade all the way up until here. At this point, they make a bullish cross and I can enter a trade. And I can stay in that trade until the next bearish cross, which comes here. Even though this is a very small margin here, I will be making a very small profit, but it is a 4% profit nevertheless. I'm happy with that. During a bear market when the price is going down, this is actually quite a decent profit. So I'm out of this trade all the way until I see the next bullish cross. And the next bullish cross is here, when the blue one, the shorter one, is crossing the longer one, the pink, on the upside. So at this point I'm entering another trade. I'm staying in this trade all the way up until here and I'm exiting this trade. So in the short term, this is how I'm going to play this market. But ideally, I want to be looking for bigger gains, and this is why I'm actually using the 50 and the 9 EMA more than I'm using the 5th and the 8th EMA. Because for me, I'm actually looking for these bigger gains, which are coming from kind of bigger time frames. Holding for a couple of months is when I'm actually making a much bigger profit than exiting and entering every other day. So if you're a position trader, definitely the 50 and the 80 MA is in your favor. It's the better tool to use. But even if you like swing trading and you like the shorter time frames, the 50 and the 80 MA are ideal for that. Alright, well, this wraps up today's episode of Crypto Corner, everyone. Thanks for staying until the end. I hope this brings you value, and if it did, please share it with someone else who will benefit from watching this. Also, if you want more crypto content like this one, make sure you're subscribed to this channel and show your support by leaving a like and a comment below. This will help the algorithms pick up this video so that it can reach more people. Also, make sure that you check out the links in the description below, where I list all of my top crypto services, exchanges, wallets, my top charting tools for market analysis, and my 2 ebooks that will help you get a better understanding of everything in the blockchain space. I also send out the Crypto Corner newsletter, where I share with you market insights every 2 weeks, in the beginning and in the middle of each month. So grab the link from the description below and join my mailing list. Trade carefully and stay profitable.